Hi everyone, hi. Welcome back to the Automatic Wealth Academy. So, today we'll be diving into an interesting question, okay? Why Warren Buffett, who is one of the world's most successful investors, avoid real estate? So, while real estate is often seen as a great investment strategy, Warren Buffett takes a different approach. He believes there are better ways to grow wealth, okay? And that's one of the main reasons. So let's break down his reasoning and what lessons you can apply to your own financial journey, okay? So the first reason Warren Buffett doesn't really invest a lot in real estate is that he thinks it's actually too accurately priced. So, taking a step back, Buffett made his fortune by finding stocks that were undervalued, and he still does today. So he finds stocks that are trading for less than their true value. Okay? However, he believes that real estate doesn't offer many such opportunities. So, unlike stocks, he thinks that real estate prices tend to be more stable and therefore reflect their true value most of the time. So it's rare to find properties which are significantly undervalued, except in special situations, like, for example, foreclosures or economic downturns. So this means that for Warren Buffett, it would be, and therefore also for us, it will be much harder to gain a significant advantage in real estate compared to in stocks. So for most investors, buying undervalued businesses and holding them for the long term can provide better returns and with much less effort. So Buffett believes that investing where he has a competitive advantage is the best strategy of all. In fact, that's what he usually does, and that's what he says. You have to stay in your circle of competence. The circle of competence is fundamental. So, in his case, he doesn't have a competitive edge in real estate, according to him. And why? Because of many reasons, but a few of them are, for example, that large firms like REITs, private equity companies, tend to dominate the real estate space with superior resources and market knowledge. So these firms can negotiate better deals, they can secure bulk discounts, and have better management infrastructure. So competing against these firms as an individual investor can become challenging and often unprofitable. So if you don't have an inside advantage, it may be smarter to invest in businesses where you actually can have some inside information and leverage your knowledge and research. Then there's also the tax inefficiency problem. Real estate is tax inefficient for corporations. So Buffett also highlights this, saying that he would have a tax disadvantage when investing in real estate. Okay? Real estate income for corporations is taxed twice. So once at the corporate level and again when it's distributed to the shareholders. So this makes real estate investments less profitable for corporations, just like his Berkshire Hathaway. However, for individuals or real estate specific entities like REITs, they have a different tax structure that do make real estate more appealing to them. Okay? So for those looking to invest in real estate, understanding the tax implication is crucial to maximizing your returns. Then, also, according to Warren Buffett, real estate requires too much management. So unlike stocks, real estate is not a totally passive investment. Okay? Owning rental properties comes with numerous responsibilities. You have to deal with tenants, deal with maintenance problems, repairs, then you have to manage your cash flows, you have to manage the mortgage, tax properties, so many things to handle. you have so many unexpected issues like vacancies, property damage, legal disputes. Okay, so Buffett prefers investments where the business management is handled by skilled professionals. So that allows him then to focus on more strategic investment decisions. Another big problem, which also Warren Buffett really doesn't like, is the illiquidity problem, which is another big drawback to real estate investment. Selling a property takes time and involves high transaction costs, while stocks, on the other side, can be sold instantly and with minimal cost. So this also creates a problem of tying down the capital for long periods and long times. They're not as liquid, so you would have to keep them and tie them down for longer periods. This makes it difficult to react quickly to market changes. So if it's difficult to sell a property and the market situation changes, Warren Buffett needs and wants to be able to reallocate his capital in other kinds of investments very efficiently. So for Buffett, liquidity is a key factor in investing. He prefers assets that can be easily bought or sold whenever needed. But there are some situations where Warren Buffett has actually invested in real estate. Despite the overall stance, Buffett has indeed occasionally invested under specific conditions. He's invested, for example, in situations where there's been economic crises, like in the 1980s and 90s. In that case, the US government was forced to sell off distressed properties at a very deep discount. So Buffett saw the opportunity and made a few strategic real estate investments. Or through public real estate investments rates, where Buffett has invested because they offer diversification across multiple property markets. They're more liquid, so you can buy and sell the shares very easily. They have professional management, so specialists that can handle all the real estate related responsibilities. There are discount opportunities for them because sometimes rates can trade below their net asset value, making them attractive investments. So by investing in rate rather than a physical property, Buffett gets exposure to real estate without the headaches of the direct management. But he hasn't invested in rates many times. So it would still be just now and then investments over his lifetime and his career. So what are the key takeaways that an investor can bring home from what we just said? Real estate is a great investment for some, and it can be. I also believe in real estate as a way of diversifying your portfolio. Buffett believes that though most people should focus on buying shares of high quality businesses at fair or undervalued prices and keeping them for the long term. Okay? And then what you do is you let expert management teams grow their investments. Therefore, you avoid the complexity of getting your hands dirty and therefore letting this passive income grow. While on the other side, you'd require a lot of effort on the real estate side. And then this way you can prioritize liquidity and flexibility in the portfolio. So if you don't have the expertise in real estate, then stay out of it, like Warren Buffett does. But if you have some expertise in real estate, who knows, you might even succeed. But for the average investor, focusing on stocks and passive investment strategies can be probably much simpler and more profitable and a path to financial freedom. So, should you invest in real estate? It depends on your skills, basically, and your situation. As always, every investor is different. Every family, every situation is different. Depending on your skills, your resources, your risk tolerance. Warren Buffett avoids real estate because he believes there are better and easier ways to compound wealth. But if the situation is different in your case, having that diversification in your portfolio with some rental properties, which you have bought with your own capital and not with a mortgage, can have sense. Even Warren Buffett's partner, Charlie Munger, always said that he had a portion of his investments in real estate. because he liked the stability of having some real estate. So it depends on your situation. In any case, if you're looking for financial freedom with minimal effort, considering what Warren Buffett said and his approach, investing in businesses that generate wealth passively rather than managing rental properties could probably be the easiest path. Okay, thank you for watching and see you soon. Bye.